Good morning. Today we're going to work on a few exercises. These are relatively short exercises that you will be doing on Wiley Plus. The numbers are going to be different for you when you work on Wiley Plus, so please be careful as you take down numbers. I'm going to do a quick screen share so that I can start showing you the exercise I'm going to work on. So the first one is going to be exercise 5-1. I've copied the exercise from the textbook. We have 5 transactions that have happened, and we've been asked to prepare the journal entries to record the transactions listed above on Rice Company's books. And they tell us Rice uses the perpetual inventory system. There's a part B to the problem. We'll get to that in a minute. So as we've been asked to do journal entries, I've set up my journal. In the journal, we always have the first column for date, the second column for account names, and the last 2 columns for the amounts that are going to be debited and credited. So to start with, over here on April 5th, I'm told that I purchased merchandise from Jack's company for $28,000. The terms are 210 net 30. As I'm using the perpetual inventory system, I'm going to be using the inventory account. So let's see what I would do. The first thing I always start with is I identify the date of the transaction, and the date is April 5th. Which accounts are affected? I have purchased inventory, which means the amount of inventory has gone up in my books. The inventory account is going to be affected. So I debit inventory for $28,000, and I will credit accounts payable. The reason I'm doing that is because I have not paid cash right now. I was given credit terms. So accounts payable credit for $28,000. The next day on April 6th, we paid freight cost of $700 on merchandise that we purchased. So the assumption is since I paid for it, the terms were free on board shipping point. So over here, again, I write the date. I have paid for it right now. So I know in the credit, it should be cash. I credit cash for the $700. What am I going to debit over here? Since I'm using the perpetual inventory system, this freight cost is added to the cost of the inventory immediately. That basically means my inventory now, the value of my inventory, the cost of my inventory is $28,700. I have 2 debits over here. That's what I paid, what I'm going to pay for the inventory itself, plus the freight cost. Then I'm told on April 7th, I purchased equipment on account. Again, this is a credit transaction. I will pay $30,000. The equipment, what type of account is this? What do I intend to do with it? If I intend to resell it, it would be called inventory. Since it's not called inventory, it means it's an asset I intend to keep with me. So we'll see how this journal entry is different. I write the date again. The account I'm going to debit is equipment. This is a property, plant, and equipment that's going to stay on my balance sheet, and that's $30,000. Again, I did not pay cash for it right now. I will pay in the future. We can credit one of 2 different accounts. What is common is it's a liability account. So I can either credit accounts payable or I credit notes payable. Both of those are acceptable. However, on Wiley Plus, please make sure you choose the correct account name over there. On April 8th, I returned merchandise. The inventory that I purchased on the 5th, I returned $3,600 of merchandise because for some reason it was either defective or it was not what I wanted. I'm making a return. So it's a very simple journal entry. Look at the first journal entry, what we had over here. In the first journal entry, we had inventory debit accounts payable credit. I'm returning $3,600 of merchandise. So all I do is I flip this journal entry. I debit accounts payable and I credit inventory. So again, just to highlight this and show you what we have done, when you look at these 2 journal entries, when you make the purchase, inventory is debit, accounts payable credit. When you return it, accounts payable debit, inventory credit. Now finally, we are told that on April 15th, I paid the amount that is due in full. So how much do I owe? Let's go through this. Look at accounts payable. 28,000 accounts payable for the inventory. Don't look at this accounts payable because that's not what we are paying, because this is from a different person, different vendor. So it's to Jack's company, which is why I said if we have either accounts payable or you identify the vendor or call it notes payable, it would be easier. So I'm going to put this in a different color so we can see this for a second here. 28,000 minus 3,600 is what I owe. So I'm paying that on April 15th. Next question is, am I paying within the 10-day period in order to get this discount, 210 net 30? And the answer is yes. Okay, so let's first start out with how much I need to pay. Accounts payable, debit, because I'm paying it off. 28,000 minus 3,600. 24,400 is the accounts payable that's being settled in full. I'm entitled to a 2% discount, which means I'm going to pay 98% of the amount I owe. So cash is going to be credited for 23,912. And the 2% discount I get, that's 2% of 24,400, that amount will be credited to inventory. I'm not losing any inventory. I'm not giving up inventory. I'm just saying the cost of my inventory has gone down by this $488 because I made use of the 2% discount that I got. Now let's look at the last part of the problem. They asked us to redo this last journal entry, assuming that we made the payment on May 4th instead of April 15th, which means I waited for the full 30 days and then I make the payment. Any day that I make the payment after April 15th, I'm not getting that discount. So once again, how much did I owe? The amount owed is 24,400. If I didn't get the discount, how much am I going to pay? Well, pretty simple. The entire amount will be repaid, 24,400. So I lose this discount of $488. If I have the money, definitely pay by the 15th to make use of this discount and pay that much less. That's money in my pocket. Why pay for it if I don't have to pay that $488? So once again, a couple things to note over here. We are using the perpetual inventory system, which means the inventory account is going to be affected each time there's a purchase, purchase return, purchase discount, and there are sales transactions. We'll get to that later on. We're just looking at purchase. If you purchase an asset, such as equipment, that is not inventory, make sure you put that under that asset name. Do not call it inventory. Also, if there's any accounts payable associated with that, when you're looking at journal entries or payments, make sure you keep that separate. So this is a relatively short exercise, and we're going to look at a few more along these lines so that we can get familiar with how to do the exercises, whether it's for our homework or for our exam. And again, keep note of what you get on Wiley Plus. Your numbers are going to be quite different, especially these credit terms. Read through your particular exercise very carefully.